I think there's two real themes. Number one is the worst kept secret. Capital markets are going to have blowout quarters.
Okay.
We're going to have investment banking up 25% year on year. We're going to have trading results up 15%. They've all guided. They're all going to beat expectations. The question there is sustainability. How do we put that into the back half of the year into 27? That's point one.
Okay.
Point two is higher for longer, how these banks are going to manage, in particular, the deposits, the deposit growth and deposit funding. So that has the outlook for the impact on net interest margins in the back half of the year. And that really, I think, has set the stage for what's happened year to date with the banks, right? The smaller banks have outperformed a little bit. They've all outperformed the S&P, but the outlook for net interest income is a big one.
Are they making loans? How's loan origination look when I look at like the Wells Fargo, the B of A's, and that type of thing?
They are. Wells has had a really, once the asset cap came off, they really went into growth mode. So that's for sure happening. More broadly, you look at the Fed's H8 data, you're seeing mid to upper single digit loan growth.
Okay, that's
and
good,
so
right?
we're getting the growth. The question is, can you fund it in a profitable manner?
So the answer to that, I guess with rates higher, how are they doing that?
It's very competitive. And so I think you're paying up for deposits. You're hearing it from companies like Fifth Third talking about the Midwest being very competitive. You've heard others talk about the Southeast, given the demographics being very competitive. You can raise deposits. The question is, how much do you have to pay for them?
Is the merger roll-up still transactions, combinations, fewer banks? Is that still in place?
It absolutely is. I would say the first half of the year has been a little slower. Last year's most acquisitive companies are in digest mode. They're integrating. But as a firm this morning,
come on, stop. I know this dance cold. It's a boom market, so we can delay merging, right?
I think that's fair. I think right now it's really good. The banks are making a lot of money. If you're thinking about selling your company, why do you sell when things are great? I think the key question for the back half of the year is net interest margin into 27 as you're doing your budget. If it becomes more difficult, margins are at 15-year highs. If it becomes more difficult, then I think those conversations restart.
The regulatory environment, give us a sense of the lay of land. How much has it changed under this administration?
It's changed in a tremendous way. Number one, to Tom's question, mergers, they're getting approved and cleared in 3 to 4 months. They're not going 12 months. So certainty, you keep your employees retained. That's a huge factor. The capital rules, Basel III, CCAR, stress testing, we're getting to finality, right? We're not getting everything we want, but we're getting a lot of what we want. And I think what's interesting is that the capital return discussion is broad. It's not just buybacks. It's organic growth, to your question. It's dividends. It's M&A. So the banks have this optionality that they haven't had in prior cycles.
Is the risk still out there? And I'm just picking on this bank, folks, because it's a name that pops into my puny head on a summer Monday. The Zions Bank Corp and all the other. I mean, is that just like history now, the weaker, troubled banks?
It is. I mean, banks' balance sheets, you look at capital ratios. Capital ratios are at 2-decade highs, right?
Yeah.
We've picked up the pieces. 2023, as uncertain as it was and as volatile as it was, we had 3 or 4 bank failures out of 4,000. So the industry's withstood that very, very well.
I got important questions for you, but let me get this one more in. Is Citigroup, do you lump them into the same conversation with the other major banks? I mean, is Citigroup, we all do this because of history, Sandy Weil and all that. John Reed, I mentioned earlier today. But as the fact is, Jane Frazier's working with a bank that's really not in the scope, scale, and magnitude of the other major banks.
They're moving in the right direction. Absolutely moving in the right direction. I thought the May 7th Investor Day was a home run. The team led by Jane.
It's only because of Kate Moore, but continue. And Andrew Holland.
They did a great job. The bar was very high. The stock head was a very good stock, and they delivered. And they gave us what I thought is a very believable path from a 10 to 11 ROE to a 14 to 15. And what they didn't do is they didn't pull every lever. They kept a few in their back pockets. So to your question, is it JP Morgan? No. But the valuation's 1.4 of tangible in Citi's and JP's 3.
What's your single best buy right now?
We love Citi. We love Morgan Stanley. You get opposite ends of the value spectrum. Citi's your deep value play. Morgan Stanley is your best in class, 30% wealth margins, 25%, 20 to 25% ROEs. So you get a value play and a growth play.
ROEs, I know, listening to Allison Williams and all the bank analysts out there, I got to focus on the returns. What are the returns the big banks are getting today versus pre-financial crisis?
So most big banks have targets in the upper teens.
Okay.
So JP Morgan is 17, they're delivering 20. Wells is 16 to 18, Citi's low teens. Pre-financial crisis, I think the difference is their leverage was so much higher, so the returns were so much, artificially inflated. So companies are doing 25% ROEs, but they had no capital, right? So now we're doing mid to upper teens on record level capital. So the quality of your ROE is much higher.